Matt Green, welcome to the show.
Hey, thanks, Matt. Thanks for having me.
Matt Green is 31 years, 33 years old,
32.
32 years old. He's got a little bit over $100 million in real estate under management right now, with around 500 to 600 doors and around 300 doors of projects going on right now. So Matt is killing it. Matt, how did you get started in real estate?
Yeah, I got back into real estate maybe 8 years ago, and my father, growing up, had real estate. He was always building houses and just expanding a company. And then we had partnered up, and he had a portfolio of assets, and we decided to partner up and really take the business off and grow exponentially. We started out when we first got going together. He had about $2.5–3 million of deals under management, and then we've since grown. Geez, I want to say 20, 30 times up to $100 million of assets right now. And we've just been growing, and we've been through a lot of cycles where we've had a lot of inflation. So appreciation has occurred. So the market's been strong, rents have been growing. And that's why growth has been so huge in real estate. And I think timing was huge, because if you got back into it several years back, you're going to experience that wave of inflation that we all experience. So I got into it based off of jumping out of a hockey career that I had. I was playing very competitively with the team out in Detroit called the Little Caesars AAA team. So I played with them for a while. We won nationals, won states. And so I always grew up as a competitor. And then I always played in different leagues, like the USHL I played in. I was scouted by top Division I colleges, and I also been scouted by like the Nashville Predators, Sabres, and other professional sports teams.
You almost went to the NHL, you being scouted. Pretty cool. So, what would you say is the relationship behind your athletic background and what you're doing now? What skills come from athletics that help you to succeed in real estate?
Yeah, I think that's a good question. I think there's a lot of skills that come from athletics. If you have the opportunity to play sports, it teaches you a lot of things like time management, discipline, work ethic, and just accountability. You're always accountable to achieving a specific result. And whether you work hard or not, it shows in your results for whether you're winning or losing. So I think that's why having the opportunity to play a competitive sport really it changes you. It makes you a different person. And then once you're in business, in real estate, or any type of business, it doesn't matter. You're going to have that competitive mindset, because otherwise you won't survive. If you're going to play at any competitive level of sports, you have to be you have to be working out religiously, exercising, train. In hockey, and in my example, you have to be skating every single day. I was on the ice 5 days a week and training every day afterwards. So I think you have to have that dedication to see it all the way through. And I think a lot of that is represented with how you run businesses too.
Let's talk a little bit about that. When you're in sports, playing hockey, working out, training, doing that every week, what is the version of that as it pertains to real estate?
I think you may have more of an advantage in real estate because you can work longer hours. You're not restricted by your body, because your muscles get tired, or once you work them out to a certain extent, you can't just continue working them, otherwise you're going to create injuries. Versus in business, you can work longer, you're not going to get injured, you can have more stability and length in your career, and you can create a lot more success. So I think being an athlete can be very challenging, but being in business, if you have the right work ethic, you can excel in.
So, talking about some of your early success, the timing in the market by getting in a little bit earlier than right now, let's say, what are your current views on the market? And what is any advice that you might have for someone looking to buy maybe their first or second investment in today's market?
Sure. Yeah, it's a good question. I think you can't be afraid to jump into the market and buy something, even though the interest rates are increasing. You still have to be competitive and aggressive. And at the end of the day, you're just penciling in numbers. So, whether the interest rates are a little bit higher, your returns are just reflected in that, whether you achieve a little bit of a smaller ROI, but you have to keep growing and expanding. So I don't think you can stop. It's just value engineering. Maybe you can reduce costs, whether you're purchasing a property and renovating it. Maybe you can raise the cost a little bit to make it more efficient so you can make it up on that end. I think it's just being creative, structuring the deal, and the way you approach it is how you can get into the market. And I think the biggest takeaway is just not being afraid to jump in, even though everybody seems like they're afraid the interest rates are increasing. I think you still got to push ahead. You can't stop.
When everybody gets afraid and everybody stops buying, that's when the opportunity starts to call and you could get in and swoop up some good deals. So now at this point in your career, you're doing some pretty huge deals. We talked earlier, you've got 160 unit, you're buying another 140 unit development deals, some of these acquisitions as well. Was it always that big, or did you have smaller stuff? Did you buy a 5 unit or a duplex or a single? Let's dig in on the smaller side.
Yeah, so basically the first types of deals that I did were like back in my hometown, it was like a 5 unit, or I'm sorry, a 7 unit and then a 10 unit. And so at the time, the 7 unit was just a block of townhouses, and it was approximately $550,000. And then the other deal was a 10 unit. It was all 1, 2, and 3 bedroom apartments, and that was about $925,000 for that deal. And then from there, we went and renovated all the units. And once we say, for example, the 7 unit townhouse, the rents at the time, they were like $dollars per month. So we went in, we put in new hardwood floors, fresh paints, cleaned up some of the appliances, just cleaned them up, made them more presentable, modernized them a little bit more. And then from there, we increased the rents to about $12.50 per month. So we had this huge rent increase from just repositioning these townhouses, which they weren't new anymore. They were dated. So once we were able to get in and renovate them all, it just made a huge difference. And then the rents just jumped. And then
Right.
after we were able to complete all 7 units, we took it to be reappraised and refinanced, and then we were able to reassess it at over $1 million. So you almost had 100% ROI on it. We returned all the equity in it, and now it's just like a free property, so to speak, and then you can just collect your cash flow from there.
Wow. Yeah. And I love that term, free property. There is some backlash on that when you say you
Yeah,
get a free property. Everybody's like, oh, but you have this debt that's sitting there. But if your real estate and your renters are paying that debt down, and you got back every dollar of capital that you injected into that asset before on the acquisition, and you
right.
refinance and pull all that out. And I would assume on this 7 unit, you bought at 550, it appraised at over $1 million. I can't imagine that these cosmetic upgrades you were doing cost more than 200,000. I would say you probably pulled out even more cash than you put into it.
Yeah, exactly. The ROI is basically infinite at that point, but
Right.
we spent about maybe $50,000 to $75,000 to get it up to par.
Do you remember what your refinance, what the loan was on that when you pulled that?
We just did a refi recently. Actually, we did a reappraisal. It was worth 1.2 about 6 months ago.
Wow. Wow, that's a heck of a first deal. That was the first deal you ever bought, was that 7 unit?
Yeah.
Wow. Yeah, and that was
Yep.
with your father as well?
Yep. Yeah, we both worked on it together, and it was an exciting deal. That was before we were into the value add aspect of the
Right.
game. And so we both looked at it, and at the time, we didn't know that there was so much upside in the rents. We felt there was a increase in rents that we'd be able to get, but we didn't think there'd be this $400 bump. So once we started experiencing that through several deals, we just formulated this model to just keep doing it and reproduce it on hundreds and hundreds of units.
And you could just keep pulling out your money and rinse and repeat. That's
Yep. Yeah.
awesome.
And as long
So
as you just got to make sure rents are increasing and that you're choosing locations that are going to withstand the test of time. You have to choose assets that you can invest in that are going to be almost recession proof, because people are always going to need a place to live. If you're investing into A-class markets, you're going to have a long-term solid investment that isn't going to deteriorate.
So what can our listeners do to look for that market? How can they verify that the market that they're investing in would be labeled good?
Yeah, sure. I think you got to look at things like household income. What's the population? Is there any population growth? What's around the area? What's surrounding the property? Is it restaurants, retail, grocery stores? Can you get onto an expressway or a throughway to get to an easy commute to work? Like all these different things play a big factor. I think, let's say, for example, you're looking at a property, but you're 10 minutes away from the throughway. Well, that's going to make it really challenging. You're going to be the first property to lose tenants because they're going to move to the next site that's closer to the throughway that has a better location. And so I think you're going to suffer with your rents if you're not located well, you're not near anything. Those assets, you're going to have lower rents compared to the well-located assets going to have higher rents, and it's going to appreciate faster, and it's going to have a better timeline for returning your equity.
Awesome. Hey, all achievements that you've gone through, athletically, financially, where you're at in your life, what is it that sets you apart from the average individual who, can't seem to find a investment to go buy or to get out of the rat race? What is it that you feel makes you different?
I think it's just persistence because I'm looking at deals right now in a different market in the South in Florida. And I basically had to start from scratch there like 8 months ago because
Mm,
didn't have any deals there, didn't have any connections, didn't have anything basically. So you had to build up the pipeline of relationships, find the deals, have enough confidence and knowledge to portray it to any seller or
right.
broker just so you can win the deals. So I think putting all that together, it just takes time and persistence, and you have to keep learning every day and figuring out systems and being creative. So when I was able to do that down there, we were able to put about 6 deals under contract, which is huge. So we're actually going right through right now on approvals. We actually have a neighborhood meeting next week. We got to fly out to for one of the properties. And I think it's just having many balls in the air too. You can't just rely on one deal
Right.
because let's say out of these 6 deals, maybe 3 of them are going to work. So it's just, you got to stay persistent, have many options open, and don't get discouraged when one of them doesn't work. A lot of people just, get frustrated if something doesn't work out, and then that kind of turns them off. Whereas I don't mind that. If something doesn't work, I'll just go to the next one and figure that one out. I'm always just
Right.
moving ahead and know that the goal ahead is much larger than what's happening in each and every day. So you just got to not worry about the day-to-day failures that come about.
And you've got all these different deals going on, different acquisitions. I am excited to hear, with your knowledge bank that you have, how you would create. If you had to go back to the start, let's say you're 24 years old, you're working a job, you're making $70,000 a year, you don't have any assets. What would you do to create financial freedom for yourself? Let's call it $10,000 a month in passive income. What would be your fastest track to get there?
Yeah, so I think the first thing I would do is figure out how much I'm spending every year with that amount of money that I'm getting. What am I actually netting? So let's say you're looking to make $10,000 per month. So if you're purchasing $100,000 to $200,000 valued property, let's say you have those two renters paying about $2,000 a month gross between the two
Right.
of them. So you got $24,000 per year, 50% of it for expenses, and then say you multiply your $150,000 purchase price by 5% interest, you're going to lose about $7,500 a year to that.
Right.
And usually, whenever I do a deal, I'm doing like an IO deal just to try and get it up to speed and value engineer things and optimize expenses and
Mhm.
things like that. But so you got anywhere from $5,000 to $10,000 of playroom in there, potentially, depending on how you buy the deal. Maybe you get a good deal on it, better than what I'm saying. Maybe the rents are higher. So there's some variables in there. But let's say you're making, let's say $10,000 per year on that one deal. So you just need to get to 120,000. You need just 10 of those deals, and
Right.
and you can find those deals. They're listed on Zillow. They're listed on all these different outlets online. You just have to find the right deal and make it work, be satisfied with the location and all
Right.
those different market demographics that you got to search for to make sure that the asset's going to grow and be consistent.
Right. How quickly do you think you could get to those 10 properties to get that done?
I guess it would depend on what the upside potential is. Let's say all your deals, you can raise the rents 200 or $300 a month. I think you'd be able Yeah, let me do some quick math. Let's say $300 times, let's say the 2 units. So you're getting about 600 more a month. So 7,200 a year. So at a 6 cap, you can increase it by about $120,000 a year. So I think
Right.
you just have to keep an eye on what your upside is and figure out that from there. And then you'll be able to project how much you can grow and expand from.
Awesome. Reduce expenses, save as much as you can, buy your first property, and then just take those cash flows, reinvest, and keep buying.
Yeah.
Awesome.
Yeah. I mean, you got to play with the deal a little bit. There's a lot of variables. Like you might get a great deal where you can double the value, or you might get a
Right.
deal where you can add 20 or 30% to it. So it's very deal dependent, but you should be able to, if you string enough deals together where you have enough upside, you should be able to, I think you'd be able to purchase about 10 deals in a couple of years. It's just,
Right.
it's saving money, keeping capital together, not getting frustrated with, because you're going to be a property manager now. You're going to be looking at maintenance and all these different things you got to figure out. So it can be overwhelming, but you just got to take a step back, look at the bigger picture, have some patience, and just see the goal all the way through.
And it doesn't have to be a 2 unit every single time. It could be
It could be
2 units
fours, it
the
could be
first year, then a
eights,
4, and then an 8. Yeah, just keep doubling it.
right? Yeah, there's so many ways you can look at it. You could look at 20 unit deals. Like just if you're strapped on capital, you're gonna have to start small. But if you have a lot of equity on hand, then I just was talking to somebody about it the other day, but it's like if you have a lot of equity on hand, you want to maximize that and buy the biggest deal that you can possible. You don't want to get, if you can skip the smaller deals, then you can excel a lot faster because the more units you have, you're going to be able to, through rent increases, have appreciation at the property very rapidly. Because let's say you increase the rents by $25 a month per year, and that by 100 doors, you're going to have a massive amount of appreciation every single year and upside.
Fantastic. Moving on to our final questions here. What is one actionable step that our listeners should take today to start on their path towards financial freedom?
Yeah, so I think the first thing, if you're just starting out, you have to start saving money so you can start putting it into the next real estate deal. You have to be an active deal searcher. You have to be looking at deals, because if you don't have a deal, you have nothing to put any money into. You have nothing to raise money for. Let's say you are
Right.
somebody that has access to people that have a lot of money. It all starts with the deal. So you have to have the deal before you can start figuring out how much money you need. So you almost gotta, it's like they're both all at the same, it's like at the same level of urgency. You got to find the deal, but you got to have the money. I think finding the deal is really critical. And to do that, you got to start making cold calls. You got to start driving around your neighborhood and looking at deals, looking at listings and signs that are out there. Survey the market, see what's in your area, and figure out what is available and what you can tap into to start placing your money to get into your first deal.
You got to find the deal before you even think about going to get the money to buy it.
Yep.
Yeah, becoming a deal finder there, definitely huge. Now, what's one question that you wish I would have asked you on this podcast that you think might help our listeners out, and how would you have answered that question?
Yeah, I think one of the biggest things is mindset. I think one question you could ask is, how much mental strength do you need to be successful in real estate? And I think it takes a lot of strength. You're working with dozens of people, you're working with employees, you might be working with residents, depending on the size of your company. You got to work with lots of different people. You have to be very adaptable and very good communicator. So there's a lot of skills that are needed and a lot of strength that you need to push.
Build up your mental strength through, what's the best way to do that? Through education?
That's something that I had acquired that through sports. And if we lost the game, we'd be skating back and forth up and down the ice. And you just had to be very mentally tough, because you'd be tired quickly, you'd be winded, but you'd still have to keep going. So I think you can't listen to your emotions. You just got to keep going and finding a path.
And that brings us back to what you said in the beginning. You built a lot of this based off of persistence. If you have these 6 deals that you got going in on Florida and 3 fall through, then stay persistent and keep searching for more.
Exactly. Yeah, you just got to keep going.
Great. Matt, where can the listeners and watchers find you online?
Yeah, I'm on Instagram at Matthew J. Green, or I'm on LinkedIn as well. You can just find me on there, or also I'm on TikTok as well.
Cool.
Or I got my website, mattj.green, as well.
Matt, thank you again for coming on. We got $1 Million Matt Green on the show. Really appreciate your time. Best of luck on the deals that you have coming up.
Appreciate it.